Okay guys, let's face it, the process of buying stocks is not that difficult at all. But what is difficult is choosing companies that consistently beat the market. And of course, that's something most people just can't do without expert knowledge and years of experience, which is generally why most people are on the lookout for stock tips. My strategy and tips are tried and tested and will deliver positive results for investing in the stock market. But first, why invest in the stock market? Well, you only have to look at the long-term returns from various indices and exchanges. Look at the Nasdaq. Over the last 5 years, which also includes the pandemic, it has gone up 207%, which is more than triple. That is an incredible return. Then we have the Dow Jones, which has gone up over 100%, which is more than double. And finally, the S&P 500, which is more than double too at 121%. If you compare these results to a savings account, well, you'd just be crazy not to have invested in stocks. So now you can see why it makes sense to invest in the stock market. So let's give you the best tips to get into the game. So here we go. Here are the top 7 best tips for investing for beginners. Number 1, start right now. Obviously, the best time to start to invest is actually behind us, but the next best time is right now. And with compound interest as your secret weapon, you don't actually need a lot of money to get started. As Warren Buffett advises, compound interest will help transform your small investment into a significant amount of wealth over time. So start today. For example, if I put $5,000 into a savings account and add just $500 each month, over a period of 30 years, that's a total contribution of $185,000. Nice, you say? Yeah, agree. However, alternatively, if I had invested this money with a compounding interest rate at an average return of 10% a year, this same investment gives me more than $1.2 million. And please note, this 30-year average return on the Nasdaq is 10.72%. So this 10% compound is a reality. Number 2, check your emotions at the door. Another quote from Warren Buffett is, "Success in investing doesn't correlate with IQ. What you need is a temperament to control the urges that get other people into trouble in investing." This means using your head and not letting your guts drive your investing decisions. Controlling your emotions is a primary requisite of any investment as the market passes through various cycles. So when you're in a downward cycle, you need to control your emotions rather than making a bad decision of selling the investments and incurring a loss. The idea is to understand the reason for the price tumble, accept that your investment will also go down as well as up, but it is important to be confident and optimistic about your research stock. So unless there's something really long term and is a threat to the company's earnings, you should not let insecurity or tension get in the way. The market always recovers, it's just a matter of time. So be patient and develop what they call diamond hands and not paper hands, and the market will reward you in time. Also, don't let the media scare you. The media's goal is to get clicks or views, which they often do by writing sensational headlines for clickbait. When you see headlines or thumbnails declaring the next stock market crash, just try to keep a level head and make decisions based on your investment strategy, not the latest headlines. Rarely does short-time noise, startling headlines, or temporary price fluctuations prove relevant to a well-researched chosen company which performs over the long term. Number 3, think long term. History states that staying invested in the market over the long term pays off. The longer you invest, the more likely you'll be able to weather the low market periods. This is because the advantage of long-term investing is found in the relationship between volatility and time. It is very difficult and risky to time the market. Many investors panic when they see reports of falling stock market. However, staying invested in the long run is proven to pay off. Although it appears that short-term fluctuations seem random, in the long run, the stock market trends to reflect the overall growth and productivity of the economy. Putting your money in long-term investments can also provide tax advantage on capital gains. Often, long-term gains are taxed at rates lower below your normal income tax bracket. Long-term investing can also save on transactional costs from active trading, which not only includes the cost of the trade, but also the lost margin. Number 4, research. Remember, buying a share of a company's stock makes you part owner of that business. So before you invest any money in any business, your primary task is research. If you're investing in the stock market, research the company's past performance, financial ratios, future growth, etc., and compare these to its industry peers. This way, you can determine if the company is undervalued and worthy of your investment. It is also important to understand the company's strategy and market niche or competitive advantage, especially if it's a tech startup company, as profits could be years and years down the line. If you're unfamiliar with performing financial ratios and ascertaining the company's position in context to its peers, then start by looking at a diverse range of analyst reviews and unbiased investment media sources. Number 5, keep it simple, at least at first. If you don't know how to research stocks or are too overwhelmed by the idea, then stick to index funds. Index funds let you buy a bucket of various stocks, and their goal is to try to match the performance of the market indices they're associated with. This way, you'll be effectively investing in the broader market without having to do any significant legwork. Examples of this are the FTSE, Nasdaq 100, and the S&P 500. Number 6, diversification. Beginner investors must be careful not to put all their eggs in one basket or in one company in case of the stock market. Diversification is an important part of investing, as a diverse portfolio can help protect you in the face of volatility. So it's important to ensure you have stocks from a wide range of market segments. Again, another way to solve this problem quickly and easily is once again to use index funds. Number 7, track your investment. Once you've made an investment, that's not the end of your job. You need to track it periodically to minimize the possibility of loss. It's important to track and analyze continuously whilst also researching its future prospects at different intervals. So a good idea would be to regularly check using your app wherever your stocks or investments are based, maybe every other day, just to keep an eye out what's going on, and also look in the media sources to track what's going on with your investments and, importantly, the economy at large. So that's it, guys. Those are your top 7 beginners investment tips. Implement these and you will be well on your way to investment utopia and secure your financial freedom right from your armchair. So that's it. Until next time, if you got value from this, please hit the like and subscribe buttons and also the bell for live updates on top investment options and more tutorials helping you beat the market. Cheers, guys.